Well, thanks a lot, Matt. As Ryan said, always glad to be part of the Outwardly Seed House universe and do a presentation today. I'm going to try to cover just the HRS market outlook. Mac has experienced my presentations before where I do some rural economy, farm economy, and then get into things. And he said try to keep it to HRS today, which for the most part I will. I would like to give some context for the HRS in the world wheat market, since the other classes of wheat have some impact on where production and prices will go for HRS. So just to start out, this just sort of shows where the world wheat supply in total is right now. You can see by the blue bars on the right that from a strictly numerical standpoint, the last 10 years, we've had more wheat around than ever. And even from a stocks to use ratio, meaning at the end of the day, what's left over to use the next year, we were at a historic high just a few years ago. We've come off of that fairly sharply, down from over 40% to under 35% right now, which is about where the peaks in stocks to use have been in the past. So obviously that's part of what's going on with prices elevating over the last 12 months. So I thought I'd give a little perspective on where the export market overall for wheat lies. If we look at pre-war, you can see that the export market for all wheat was pretty evenly distributed. Russia having the largest share at 19, and the EU right behind at 16, US and Canada pretty close, and then Ukraine and Australia, kind of the middleweights. Australia, even though that was a 5-year period, has suffered several short crops. And so as you'll see in the next slide, their share has increased markedly over the last 12 months, largely because they finally had a decent crop this past year as compared to the 3 or 4 years prior where they didn't. But what's more striking, this is the post-war market right now. And you can see that the US share dropped all the way from 14% down to 10%. So we were the big loser. Russia gained a little bit, about 1%. EU gained about 1%, and Australia very much back in the game, increasing their share from 8% to 13%. Ukraine, of course, dropping from 8 to 6 for obvious reasons. The interesting thing, I think, is that one of the reasons the EU share was up is that they actually bought a fair amount of Ukraine corn and then subsequently fed that, which freed up wheat to be exported elsewhere. And so that's one way in which they grabbed some of that wheat market. So Russia and EU, not big winners, small winners. Australia, big winner, and US and Ukraine being the big losers. So my apologies, Mac. This is my one slide that has soybeans and corn on. But just to kind of show, I mean, clearly overall over the last 30 years, the U.S. has lost market share for exports in all three of these crops, corn, soybeans, wheat. No big surprise there. And even if you look at the decline line in soybeans and corn, it looks as though we've lost more in those two. But really, if you take a look at it from, let's say, the turn of the century, say 20 years ago, where corn was over 60%, soybeans were around 50%, and now sitting at roughly 30% for both, they've lost about half of their share, which is a lot, certainly. But in the case of wheat, we've actually lost 2/3 of what we had. Turn of the century, we still had 30% of the world's wheat export market, down to just 10% right now. Now, granted, this last year was pretty punishing as far as what happened to our wheat exports, but nonetheless, just a continuous decline here in the amount of the market share we have in each of these three crops, and on a percentage basis, wheat being the one experiencing the most pain. So looking at HRS specifically, no surprise that planted acreage over the last 20 years or so continues to decline. For this year, we probably see that going down again, probably flat at best. If you look at what private and public estimates of total planted wheat acreage is going to be this coming year, it's actually a little higher for all classes of wheat. if we take a look at winter wheat seedings, however, we'll see that they're up. And I meant to double check these numbers, but I think it's about 3.68 million acres, call it 3.7 million, that winter wheat seedings will be up. But overall wheat seedings are expected to be up just by about 3.2 million, half a million difference. So it's hard to imagine that HRS would be down by that much, by 500,000 acres. But it certainly seems as though the downward trend here is going to continue as far as acreage goes for HRS this coming year. Crop rotation, good price of soybeans right now, various things. Fertilizer prices, although natural gas has come down quite a bit, the fertilizer price, although they've come down, are still pretty darn high. So whether that'll influence wheat seedings or not, hard to say. But point being is that most of the pressure on acres is down, not up, for HRS this coming year. From a yield standpoint, I put this one on here just because it's no surprise that if we have a drought year or a super wet year, whatever, that yields can be down. But it makes the supply really hard to estimate just because of the sheer magnitude of these yield changes. So for instance, you can see from this chart that over time, not unusual for us to be as low as the low 30s or 35 bushels per acre. The general trend is up. And of course, we can have as much as 45, 47. So if you think about the difference percentage-wise, it's startling, almost a 30% change from the low to the high. That would be comparable to, the corn yield being down 50 bushels in a year, or the soybean yield being down 15 bushels. So it makes it really difficult forecasting-wise, just because of the extreme variability on yields for HRS. So if we look at total production, then you can see that the total production of HRS kind of trending downward. And of course, that's a combination of the downtrend in acres mitigated by the general uptrend, even though we've had some poor years here, the general uptrend in yield. So this past year, kind of middle of the road at 446 million bushels. We did not, I apologize, didn't have an estimate on here for the 23-24 crop. But given the fact that the yield this year was pretty stout and we expect acres to go down, I would say that the total production this year, if we reach 450 million again, then we'd be very, very happy with that number. Domestic use, that also pretty darn even, pretty steady. Not a lot of change there, kind of fluctuating between 200 and 300 million bushels. This actually is estimated total usage for this marketing year. We think I probably should have had a dashed line for that between those last two dots, but we are expecting about a 300 million bushel domestic use this year. So the good news is that the exports of HRS really nowhere near as ugly as the other classes of wheat. You can see, yes, we're kind of at the lower end of this range of roughly 200 to 325 million bushels that we've experienced over the last 20 years. But compared to the fact that we lost basically 2/3 of our world market share over that same period, you can see that the exports of HRS have been far more durable than the other classes of wheat. We've got one chart to kind of help explain that here in just a minute. So that's the good news. Certainly you hear the gloom and doom about wheat exports in general, but for HRS, not nearly as bad. Also showing here that imports are pretty steady right around that 50 million bushel each year. So here we can see that the HRW, which typically is, the exports there are much higher than HRS, actually nearly equal this year, with HRS being actually a little higher at 230 million versus the HRW at 220. In talking to a longtime trader of Kansas City wheat and an individual who's also president of the Kansas City Wheat Exchange for some time, he was telling me that up until now, they've really felt like the inelastic demand for exports for HRW was around 240 million bushels. Well, lo and behold, this year we're down to 220. And so they're kind of revising that, thinking that maybe 200 now is that sort of bottom number. for HRW. We'll see if that turns out to be the case or not. Fortunately, HRS on its own has been kind of holding its own versus HRW, which clearly not. So if we want an answer as to why the HRS market is a bit more durable, it's just kind of taking a look at where the destinations are. It's almost entirely Southeast Asia, Philippines, Japan, Taiwan, South Korea, a little bit to Mexico, but then again, Thailand, China, Vietnam, Malaysia. Roughly, I added it up last night, I think it was something in the 90% range going to Southeast Asia. So not really our only real competitors we'll see in a moment here is Canada, which exports a higher percentage of their crop than we do. But those markets have been relatively steady, been relatively friendly. And so that's where the durability of those spring wheat exports comes in. If we look at Canada as a competitor, we can see that from a production standpoint, this is all wheat. We can see that the Canadian production is roughly 3/4 of what ours is at 1.25 billion bushels. We're at 1.65 billion bushels. But from an export standpoint, Canada exports a very high percentage. 2/3 to 3/4 of their wheat crop gets exported. Obviously, that's not all HRS per se. But nonetheless, they're exporting a much higher percentage. I should note also that their acres, the wheat acres, are expected to rise in Canada this year by about 4%. Some of those, of course, will be HRS. And so from a supply of an exportable supply, they should have plenty and be, as always, a stiff competitor in that market. Just another way of kind of looking at the U.S. wheat export commitments here, as far as how poor they've been. And even though they're down, we can see that it's unlikely right now that they'll meet USDA's expectations. The black dashed line is the 5-year average, which is about 900 million bushels. The 21-22 crop, we were just over 700 million. This year's estimate is 775. And yet you can see for the trajectory here, things are going to have to pick up rather quickly if we're going to meet that. Clearly, we haven't benefited, as illustrated from the previous charts, from any demand or lack of exports, pardon me, out of Russia or Ukraine. So it's hard to imagine that more than halfway through the marketing year that we're going to be able to make up that difference. So likely USDA will be adjusting that balance sheet in the WASDE reports to come. So looking at winter wheat seedings, and we can see that obviously a very long-term trend, 40-year trend downward. The last 2 or 3 years now, suddenly an uptick, and this year a very sharp uptick. So should we be concerned about that? Is there going to be a lot of HRW this year? If we take a look at where the acres increased, and of course Ryan kind of alluded to this, you can see that the 800-pound gorilla in the room here is the state of Texas, adding 26%. So bear in mind that this past year, there were a tremendous amount of cotton acres planted in Texas. And frankly, in talking to producers, a lot of that was insurance farming. They had a pretty bad drought there, obviously. And so there was a record abandonment for cotton acres this year, just a huge abandonment. So what did that get planted to? Well, it got planted to wheat. But it remains to be seen how many of those acres will get harvested for grain, not just because of drought, but with cattle prices where they are right now. A lot of those acres will be fed, they'll graze cattle on them. Some of them could be turned to wheatlage. So exactly how many of those acres and what quality that will be, very much in question. So even though right now it would seem that there will be God's plenty HRW, pardon me, in the coming year, it's very possible that that won't be the case, depending on a number of things. A, drought. B, cattle being grazed on it. And C, whether or not some of it turns to wheatlage. So U.S. wheat ending stocks, just like although you can, the world ending stocks have coming down very markedly from almost 60% of a crop to now only about 30%, which is obviously good. And that's, again, one of the reasons why we're seeing better prices. unlike the world stocks to use ratio, where we have come down to what the highs have been previously, you can see that we're getting back into a bit more manageable situation. Still a full 30%, far more than corn and soybeans. Corn and soybeans are both 10 or under, but nonetheless, something that's favorable for pricing. So this isn't real readable, but the reason I included this is if you look at the stocks to use ratio, we're estimating coming down to 30% total. This is a chart showing just stocks to use ratio for HRS, the operative column being the right one, where if you look, this 2023% will be just 22.8%. So, and that's the lowest by far over the last 10 or 12 years. So essentially saying that this chart is good for all wheat. That table actually looks better for HRS in that we're at a 10-year low and much lower than we've been. So again, what does that do for you? Well, here's a price chart comparing the three main classes of wheat that we grow. SRW, always the lowest, far lower this year than the higher protein wheats, HRW, and of course, HRS as well. Excuse me. So from a price standpoint, and we'll take a look at a chart here in a second, but we do expect not that high of a price this year, but still elevated. Looking for a futures price between $8.50 and $9.50. If we take a look at the daily chart, and I know there's a lot of colors and a lot of lines here, but each of these bars represents 1 day's worth of activity. And you can see here about 2 weeks ago, we hit a low, it wasn't quite a contract low, but essentially a contract low, just because when these contracts come on, 18 months ago or so, the activity doesn't mean too much. We've had a nice recovery since then. This is largely due to, unfortunately, what appears to be an escalation of the war. And so all classes of wheat have had a bit of a rebound. Nonetheless, if you look at roughly the $9 mark, there seems to be quite a bit of resistance there. It'll take something to push us through that. If so, then we're going to find again some resistance right at that $9.50 range. Now, a $1 range isn't a heck of a lot. It's just that, again, as Ryan alluded to, so much is going to depend on weather. We saw that yields in HRS, as in other wheat classes, can change quite radically, with good or bad weather. But based on what we know now, worldwide supply, acreage, etc., we feel like we certainly wouldn't be selling right here. If we get up to the $9 mark and stall, is a spot where you might want to begin sales, but certainly $9.50 not out of the question moving forward. This is just a monthly chart of Minneapolis wheat, so of course we can see that just to sort of illustrate that. Yes, we had some high spikes here the last year, but realistically, we're still at a pretty darn good price. And so don't look backwards, look forward. So again, at that $9 mark, probably a good place to get started. So just real quick takeaways: worldwide high protein wheat balance supplies look tight, but Russia's exporting a lot. Ukraine war's indirect effects freed up EU wheat this year. That probably won't happen in 2023. We should forecast lower the Ukraine's crop down to about 40% of last year's. HRS acres likely to be flat, 850 to 950 price target. HRS still the best bet in the wheat complex. HRW will probably track with corn. So for the traders out there, buying HRS and selling HRW could be a trade this coming year. So leave it at that. Matt, any questions?
Great. Thanks so much, Kurt. Appreciate your insight there. We did have a question about why the U.S. wheat exports have trended down so much. Do you have a short explanation for why you think that is?
Well, our wheat certainly has been expensive compared to, if you take all wheat classes like HRW, and then if you look at Black Sea wheat, European wheat, just getting out competed price wise. That's really the short story. Now you got Mexico's been a good customer, but of course they're close by. And the HRS, which can go out of the PNW to the Southeast Asian markets, that's been okay. But the big concentration where it gets exported to the Middle East and Northern Africa, we're just not competitive.
Gotcha. So cost of production wise, or just,
The cost of production for sure, and without getting too deep in the weeds here, if you look at crop insurance and other subsidies from the U.S. Government, which has certainly helped farmers quite a bit, it also has helped support land prices. It's hard to be in Western Kansas and land going for $8,000 or $10,000 an acre. Really tough to pencil that out. And so, yes, cost of production wise, just we're continue to our decreasing competitiveness in the world market.
Gotcha. Great. There was one more question here, and then we'll transition to our next session here. So continued decline in grain exports with corn, soybeans, and wheat. Does that have any correlation with different markets requiring, say, non-GMO or any other export considerations there?
It hasn't yet, but Mexico is the big unresolved answer there. They've come out and said that they're just not going to accept in 2024 GMO for corn imports anymore. Well, that's pretty big news. They're a good customer of ours. They then came out and said, well, that'll just be for corn that is for food exports. Which, if that's imports, if that's the case, well, fine.